Hello and welcome to this episode of Money View from the Top. A big welcome to all viewers of Daily Hunt. Today I'm bringing to you a veteran of India's capital markets, someone who's seen the equity markets very closely for almost 3 decades. Venugopal Manghat, who is the CIO Equities at HSBC Mutual Fund. Venu, thank you very much for joining us today. Daily Hunt has a very young viewership, people who have obviously invested, as you know, significantly in the last 2-3 years. And so therefore, thank you very much for taking out your time in these volatile times, if I may say so, and addressing some of the educational needs. Venu, thank you. My first question, Venu, when you started your career. I remember when I started mine, almost around the same time. 100-point fall or rise in the market, and we journalists used to write, "Markets have crashed" or "Markets have boomed." Today, that number has become 1,000 points. And of course, I mean, while in percentage it's moving the same, but when a new investor sees 1,000-point movements up and down, there does seem to be a tendency of fear that creeps in. What is your view on volatility and how to deal with it for especially for new investors who've come into the markets in the last couple of years?
Thank you very much, Vivek. I think it's a pleasure to be here with you and speaking to you and your audience. So thank you very much for that. I think the volatility is a part of equity markets. Sometimes you have rallies and upsides, and sometimes you have downsides, and it depends a lot on lots of factors. I mean, it just finally it all boils down to the fundamentals and what is the earnings growth and the valuations, etc. But there are several other factors that influence markets. One has to understand, and these may not be in your control. They, probably are not so well understood. There are factors, both domestic as well as global, which impact markets. And so volatility increases because of all of these. And market is a collection of so many different individuals with different views, different outlook on, the world markets, world economy, and what's happening around us. There's a lot of fear and greed that goes on in the minds of investors, and every investor is different. So collectively, therefore, you have these influence the markets, and therefore the volatility that you see. The key is to have, however, remain invested patiently over long periods of time to see how you can compound your returns over a period of time. Invest in good quality companies, invest in good quality funds, invest in the right markets, and stay invested for long enough. Be patient. Despite volatility and gyrations in the market, you need to remain patient with your investments and then reap the benefits out of that. And I think we have seen that if you remain invested beyond 10 years, 15 years in the equity markets, the probability of making a principal loss becomes almost zero. I mean, it's almost 100% of the time your principal is protected and you get a reasonable return. And in the last 15 years, we've seen that the returns from the equity markets have been higher than inflation by a wide margin, obviously, and higher than most other asset classes as well. So therefore, the key is to remain patiently invested and not get carried away or not get bothered by so much of these, the volatile movements in the markets. It will happen. It is part of the equity markets, but you will have to live through it and wait for your returns to come.
Venu, two developments that have happened in the more recent past that I want to talk to you about. First is, we've seen in the last 2-3 years almost a few crore demat accounts being opened, and a lot of young investors coming in and trying to buy shares or sell shares, as the case may be, directly. And of course, at the same time, we've seen strong inflows into the mutual fund industry as well, and especially through the SIP route. Uh, so I want to talk a little. The third part I won't talk to you about, which is the crypto bit, which happened with the millions of young Indians going out there despite a lot of sane advice being given. Many have burnt their fingers, but let's not get into that conversation. But the first part about, and especially since you are someone who started, your journey right from the beginning, went up, and today you have a big team of people working for you, but you've been a stock analyst, stock picker, decision maker over the last 30 years. And I want to, want you to tell the young people out there what goes into picking a stock before you jump in and start wanting to, invest on your own. What's the kind of skill set that you and your team, or the rigor that you and your team go through before buying even a single share?
Sure. That's an interesting question. I think, before buying a share, first of all, you need to understand what you're getting into, and not blindly get into something that somebody has suggested or you've seen on a media channel or read in a newspaper and, just gone and bought that. That definitely is not the way to do it. You need to study the company in detail. You need to understand the business, and when you buy a business, you should understand what that business is all about. Who is running it. Most importantly, who is running it. Can you really rely on that person or the team, the promoters, the professionals behind the show? And I think in India, and I think all markets are the same. If you get two things right in general, I mean, a very macro way to look at it, two things right. If you get two things right, then you have kind of made your return. And the first is obviously the quality of company and the runway of growth that is there for the company and the business over a longer period of time. Without which, obviously, there is nothing much that you're playing for. Then it's just the dividends or the stability that you're looking at and not growth. And the second aspect is the people behind the show. And once you get these two aspects right, I think you're 70-80% of your work is done. When I say people behind the show, I mean the integrity, the alignment of their interests with the retail investors or the general investors at large. Also, the kind of passion, the ability, the vision, the energy they bring to the table to drive the company or the business to the next level. That is the most important piece, and the growth path that the company has or the business has, the runway of growth ahead of them over a long period of time. I think these two factors together should help you, from a very macro level, decide what you should be doing. Obviously, from an institutional perspective, we do our due diligence more rigorously. We speak to the company before we invest in any company, and we track a large enough universe. We have a universe of more than 450 companies now that we track between our analysts, and we have a team of 8 analysts at the moment. And so we on a constant basis, we are monitoring these companies. We are regularly in touch with these companies. We attend all the conference calls, post quarterly results, and also other conferences. And therefore we are in regular touch with the business and the people behind the show. And hence the institutional way of looking at these stocks and picking stocks from them is a little different. Obviously, the question was for the smaller investors, the retail investors. How do you really look at this? I think like I said, the key is to understand the business, look at the people behind the show, read about the company, understand the factors that drive the business, and spend time with it, and just not go and buy once you hear something about a company and you like it. The next day you go and buy something is not the way to do it. Spend time with it, see how prices are moving, see what the fundamentals are, try and correlate between the two, and then you will get a sense of what the company is doing and why the share price is reflecting what it is, or what it is, where the share price is and what is reflecting or what is the underlying business fundamentals that is getting reflected in that share price. So it takes time to get that correlation right. So spend time with it. Look at the prices. Look at the go through the results, the past results, as well as what is coming, at regular intervals, and then decide what you need to buy.
What you've done is Venu explained so well why this is such a difficult thing to do for an individual, and it therefore makes just so much sense to hand over your money to experts like you and many other such experts, mutual funds, like you, which are doing a great job of building wealth for people. It is not easy to do all of this, what you talked about, for an individual who's also working. So all you young people who think it's very easy to go and pick up shares, I'm sure and I hope you've taken note of what Venu just said. Venu, on the other point about SIPs and their success, so one is, of course, the headline number that we keep reading, the 13,000 plus crore that we have reached while we are speaking at this point. On the other hand, some of the data that seems to be reported seems to suggest that the duration also seems to be increasing, while we are still seeing a fairly high number of SIPs being discontinued and fresh ones coming. But do you believe the SIP story is a good way for young people to build wealth over a period of time and at the same time handle volatility and develop the discipline of investing regularly?
Oh, absolutely. I think you've hit the nail on the head. I think the important thing is to be disciplined. Important thing is to save first and then be disciplined to put money in the right place on a regular basis. Nobody has a crystal ball, and so it's foolish to really try and time the markets and see how much of correction is going to come and when it is going to come, etc. And the best way is to, if you believe that India is a great story, as all of us believe, and you have a 10-year, 15-year time horizon to invest, it is best to, log into this story and remain patiently invested. And how do you get into this story? I mean, you can buy in lump sum. Obviously, that is a, easy option. But most people are, there is always a chance of markets moving up or down in the near term or in the next few months or, year. And therefore, the better way, obviously, is to do a SIP and keep investing on a regular basis. The other point that you mentioned about the discipline and on a regular basis, keeping aside some money and putting that into a fund, obviously, it also brings in some financial discipline to the investor. So I think definitely that is a better option. That is a better approach to investing. The trend seems to clearly suggest that the SIP book is increasing year after year, and I think from my experience and my interactions with a lot of people, including distributors and partners as well as investors themselves, it clearly tells me that the market is getting far more savvier, and more and more people are asking questions about how do we get into this and how do we, what time frame should we give to stagger our investments? Should we do SIP for over 6 months, 1 year, 2 year, 3 year? What is the best option for us? Those are the questions that are coming up now more often than, should we do this or not, or should we invest or not? So people have moved further. I think they've become far more educated on this and more market savvy. And I think this approach to investing is clearly gaining traction as every month numbers are showing.
Venu, the lament that people like you, one of India's finest fund managers, and all people of your experience and pedigree that I've spoken to seem to have is that, we worked so hard, we built wealth over a period of 20, 25 years, and there are a fair number of such schemes which have actually delivered that kind of CAGR over 20, 25 years. But the lament or the bad news is that very few people actually took advantage of that 25 years, because if you see the overall number of people who invested in those schemes, and if you see those who stayed invested for those 25 years, then it becomes just a handful. Uh, you talked about the India story, and don't want to talk about the past, but uh, can the next 10, 15, 20 years, so if I'm a young investor or a new investor, let's put it that way, and I'm investing right now for the next 15, 20 years, I know we always say that you can't go by past returns. So just because a set of schemes deliver 20, 25% CAGR doesn't mean they will in the future. So I'm not asking you for a number, but do you feel that the next 10, 15, 20 years, given where India currently is, could be a great period for building wealth, just like our generation missed out when the last 20, 25 years presented that opportunity?
Yes, I think we are probably, I mean, in my view, we are probably fortunate to be a part of this generation, at this juncture where India is at the moment in its, life cycle, if I may say so. It's clearly, or economic cycle, if I can say. I think India is currently at a juncture where US was multiple decades ago, or China was some time ago, or Japan was a few years ago, or decades ago. We are, getting everything now in place for a multi-year growth trajectory, and we are crossing, significant thresholds on different parameters. I mean, whether it is per capita income or the investments to GDP also is getting better now. So multiple things are coming together for us. Obviously, the big advantage for us is the demographic profile and the young population that we have. The increasing middle class, and the people the aspiring class who really are consuming a lot more. And once you cross a certain threshold of per capita incomes, as we've seen in multiple geographies in the past, the J curve kicks in terms of consumption. So you have investments going for us now. You have consumption going for us now. You have to a large extent exports, and the external story also getting better for us, because Indian companies are clearly gaining market share across the world as a good sourcing base, as an alternate sourcing base from China, or versus China or Russia or any other competing markets. And I think that's a very important aspect for us. When you talk about the next 10, 15 years, because India can really become a superpower in terms of manufacturing, where we have been lagging for long. And so there are great opportunities, and that's why I'm saying that I again stress the point that I think we are fortunate to be in this part of this generation where we can create wealth over long periods of time. But the most important thing is people have to stay invested for this to happen. And the 10-year CAGR for last 10 years could be somewhere in that 16, 15, 17% range. But only people who have remained invested for 10 years would have got that. And so I'm sure if you had even stepped out of the markets for a year or two in between, and come back again, you would have still not made that kind of CAGR returns. So it is important to stay invested. It is important to believe this story. It is important to understand that we are at those thresholds in terms of growth, and we are lucky to be a part of this.
Absolute pleasure speaking to you, Venu. Thank you very much for taking time out and educating millions of viewers of Daily Hunt. Look forward to many more conversations, and wish you all the very best in your merged and stronger and bigger entity, and wish you all the very best in life. Thank you.
Thank you, Vivek. Thanks a lot.